around which we have centered our research and investing for years. So robotics, energy storage, AI, multi-omic sequencing in the life science space, and blockchain technology. All of them are being catalyzed by AI. Of course, AI can't catalyze itself, but you know what I mean. All of the other platforms are being catalyzed, and I think the speed of change is going to be pretty shocking over the next few years. And there are shades of it, or signs of it, in the unemployment report, and we'll get to that in a minute. I just wanted to point to this chart as well, because I've just taken a trip through Asia, and it is clear
amid the most substantial growth phase in its history and a sharp rise in interest from institutional investors, Bitcoin's progression toward the $1 million milestone has never seemed more certain. This is the latest prediction from Cathie Wood, the CEO of ARK Invest. Based on her analysis, Bitcoin is swiftly establishing itself as the favored store of value, beginning to take a share of the $15 trillion gold market, while simultaneously attracting new investments from developing economies as well as sovereign wealth funds. Research conducted by ARK shows broad-based adoption across corporate balance sheets, major financial institutions, and ultra-high net worth individuals. There has never been a more compelling case for Bitcoin to reach a seven-figure valuation, with the supply fixed at 21 million and demand continuing to grow daily. What is expected to present a detailed explanation of why the path to $1 million is accelerating, and how the global financial system could potentially experience a major transformation within the next 5 years. Stay tuned.
That the only focus in Asia is on tariffs and those headlines, but they're not focused on the massive deregulation that's taking place in the United States. Crypto, we're seeing big changes there, of course, legislatively, and also in the court system and in the regulatory system. So there we're seeing the first executive order, I think, that President Trump rescinded, this was a Biden executive order, was on AI to free up innovation in that space. Nuclear energy, all kinds of energy to solve the power needs associated with AI and data centers. Huge deregulation, huge. Now that is slower and moving by nature, but on our site you will see how much regulation has held back nuclear energy here in the United States and in Japan since the 70s. And we're rectifying this 50-year problem now at warp speed, at least for that sector. And just to give you a sense, China is constructing today 28 large-scale nuclear reactors. In the U.S., we are not constructing one. We have been so constrained by regulation. And the antidote to that has been small modular reactors, and those are proceeding apace. Again, regulation takes time, but again, proceeding apace. And we think from the largest to the micro nuclear reactors, we're moving into a nuclear age. When Brett Winton and I were at our last firm, Brett and his team authored a book, a big black book, on nuclear and how safe and sustainable it was and is. And then unfortunately, Fukushima happened in Japan and unraveled nuclear for yet another decade, more than a decade. Again, the regulators had the upper hand around the world. And now we're back, and so that's good. All of these are going to feed economic growth importantly during the years ahead. And you can see here tax changes that are going to encourage this. So manufacturing structures If companies get their manufacturing structures up within the next 3 years, they don't have to be quite in service, but if they have them essentially finished, and maybe to be put in service a little later, they will be able to depreciate in 1 year the depreciation. They will be able to expense in 1 year what normally would have taken 30 years to depreciate. So that's massive tax savings. And this is good for the next 3 years. And so we think there's going to be an explosion in manufacturing capacity and all other kinds of investing. And we think there's going to be a huge amount of foreign direct investment, especially given the Trump administration's strong stance. But you can also see here equipment, domestic R&D, software. These are fully expensed in year one. Now, these changes have been made permanent. And as you can tell, they're aimed squarely at innovation. And so we think that's going to cause an explosion in the 5 platforms I've just mentioned. They're going into overdrive. And so we think that's very exciting. And that's part of the growth story moving ahead. And importantly,
ARK Invest began its research into Bitcoin in 2014 and released its first white paper on the subject in 2015. At that point in time, Bitcoin was anticipated to become the bridge enabling global access to digital currency. However, Tether ultimately filled that role, showcasing its groundbreaking capabilities during times of crisis, when families in developing countries bypass traditional systems through black market transactions to obtain US dollars online. While ARK's $1.5 million projection for Bitcoin is slightly moderated by this shift, since it lessens the focus on emerging markets, it has not changed the core drivers behind their outlook. Bitcoin continues to serve as the primary institutional gateway to the world of digital assets, while also steadily establishing itself as a modern alternative to gold. ARK's analytical framework is equally relevant to Ethereum and Solana, and is supported by institutional-grade education in areas such as on-chain analytics and detailed risk-return modeling. This holds true despite the fixed supply and rising usage across various sectors. Cathie Wood remains confident that Bitcoin's trajectory toward surpassing the $1 million mark within the next 5 years remains solidly intact.
It's part of the productivity boom we see emerging. And productivity is going to be very important in terms of not only holding inflation down, but driving it down. And we've been saying this for quite some time. Inflation may seem stuck in the 2 to 3% range right now, and tariffs are aggravating that, of course. But we would not be surprised to see inflation drop in the years ahead to 0 or even negative. Because we think the innovation that's taking place now is going to be pretty explosive. And technologically enabled innovation is deflationary by nature. It follows learning curves, which are expressed in cost declines. It's all about efficiency. And so we think that's going to be a big part of the story. And here you can see, and I've repeated this a few times, but it is important in terms of attracting investment to the United States. Adjusting for what I just showed you in terms of the depreciation schedules, the effective corporate tax rate, the tax rate today is 21%, down from 35% in the first Trump administration. He got it down to 21%. Now they're not operating on the tax rate as much as they are the effective tax rate through these depreciation schedules. And that will get taxes down to roughly 12%. I was just in Hong Kong, which prides itself on very low tax rates, corporate tax rates, and that has attracted a lot of investment. But if you look at the tax rates there versus in the United States, at an effective tax rate of 12%, we are below Hong Kong's 16.5%. I believe they have, for very low levels of corporate income, up to, I can't remember, 100,000, something like that, 8%. But beyond that, and that is what we're talking about, 16%. We are lower than the Hong Kong schedules. That's important and interesting. And we're about as low as Ireland. Ireland's 12, I think it's a 12% tax rate, has attracted enormous investment, particularly in the pharmaceutical area and the tech sector. And we think a lot of that investment, again, encouraged by the Trump administration in all kinds of ways, a lot of that will make its way back, at least partially back. So now on to monetary policy. So you can see here in the purple line is money growth, the growth in money supply. You can also see, going back to the early 60s, we've never seen money supply drop as much as it did in recent years, but then again, we never saw it boom as much as it did during COVID. So that adjustment process is pretty much over, and you can see at 5%, it's still below the average of this period. Really, it's post-World War II period. Now, you can see the green line is CPI inflation. The money supply has been pushed ahead by 18 months, and many people think that the inflation rate follows with an 18-month lag. So they are concerned that inflation is turning up from roughly, I think it's 2.7% right now, and will follow money growth higher. And even today, I think one of the Fed governors, Goolsbee, said he's concerned about services inflation, and we'll show you a chart in a moment about that. So this is top of mind for the Fed. I think that Chairman Powell is very focused on services inflation as well. But we have reason to believe that services inflation is going to decelerate quite significantly. Housing, or large parts of housing, is a part of service inflation, and I'll show you in a minute. Housing price inflation is decelerating on the existing home sale side and continues to drop on a year-over-year basis on the new home side. And there's reason to believe that drop will deepen in the next 6 to 9 months. So I want to show you a very important chart now on why we think money supply growth is not going to fuel inflation, or this recent acceleration is not going to fuel inflation. This is a chart of M2 velocity, that is the green line, and mapped against the labor participation rate. Now, velocity is the rate at which money turns over. And in 1997, it peaked in the United States. And it had been increasing secularly for decades. It peaked, and as you can see, it has been falling for the last 25 to 30 years on balance. Now, it is cyclical. When we go through a downturn, a recession, velocity drops, and you can see here it collapsed during COVID. Why? Because people were very afraid, and so they held back their on spending, especially in the beginning, thinking that we were all going to lose our jobs, the world was entering a global depression, and we needed to save money, save it for that very rainy day. And so it collapsed. Cyclically, it has moved up, but it moved up. If you were to look at a longer-term chart, and we'll provide that in the next In the Know, it has moved up to where it should, and now it is starting to fall again. And we think there's reason for it to continue to fall cyclically, but this chart explains why it has dropped secularly. As the labor force participation rate has declined, velocity has declined. Now, what may explain that may be 2 income households moving down to 1 as they have children. That's a possible explanation. And in terms of other explanations, some of it is they don't declare they're in the labor force. They are in the gray market, and so that's a possible explanation as well, whether it involves immigration or what have you. And I'm sure there are many other reasons, but this is the only relationship that we have found to explain the decline, the secular decline in velocity. So if the velocity of money is rolling over again, then that is going to diffuse money of its inflationary power. It takes away from that inflation risk because, again, the rate of turnover in money goes down. Savings rates go up. People are more conservative. And from a cyclical point of view, we also think velocity is falling because, and we'll get into this more with the labor report, there are a lot of people who are afraid of losing their jobs because of AI, and that's in the higher income households and automation generally, and that's probably more on the manufacturing level. So I think there is concern out there. It's a question when I go around the world, everyone asks about jobs being displaced and destroyed by robots and AI. And our answer from a secular point of view is technology is a net job creator. Sure, there's displacement in the short term, but these displaced jobs are usually mundane, boring, not interesting, tedious. And there are two phenomena today that will offset any of this displacement. We have baby boomers retiring at an accelerated rate. And if you think about truck drivers, a lot of baby boomers have been the truck drivers, and there are big shortages there. So autonomous trucking, we think, is going to become very important in alleviating that labor shortage. So that's one good example. And then, of course, there has been, I think, if I might have this number wrong, but the number of people leaving this country because for reasons associated with immigration, whether it's illegal or fear or what have you, is in the 1 to 2 million range. And again, many of those jobs are in mundane areas that automation will help us improve, whether it's paperwork or leisure and hospitality work. So I think this couldn't happen at a better time, given those demographic shifts. Again, though, that said, and I suggest you do this exercise. Go to ChatGPT or Grok and ask it, prompt it. We're all programmers now. We can prompt it with natural language.